REITs refer to those companies which own and operate a number of income-producing real estate assets which can produce and generate a steady income stream. Each REIT might be specialized in managing one or more types of specific assets such as office buildings, shopping centers, apartments, mortgages, or loans. The difference between the REIT companies and the real estate companies is that REIT companies do not get income from buying and reselling properties. Instead, they will buy and operate those assets and get their profits from the rent and other steady sources such as interest payments, etc. Most REITs enable investors to invest in the companies individually from the public market or through an exchange-traded fund or with a mutual fund. By law, REIT companies need to pay a minimum of 90% of taxable income in the form of shareholder dividends each year to investors. This means that investors can earn steady dividends periodically from those REITs without having to buy or operate any properties themselves. From the trading point of view, a REIT is just like a stock or ETF which can be freely traded in the public stock market. Some sophisticated real estate investors may want to invest in a single REIT which is considered having good management and successful business. On the other hand, if the investors do not want to spend effort researching a number of different REITs, they can also try REIT ETFs, which are usually based on some REIT indexes. Based on the assets the REIT companies are investing in, there are three types of REITs, namely equity REITs, mortgage REITs, and hybrid REITs. Equity REITs refers to the REITs having investments directly on real estate properties. Actually, more than 90% of the REITs are in this category. This category can be further subcategorized as the following groups. Retail REITs are mainly focused on investments on shopping centers and freestanding retail shops. Residential REITs are mainly for the assets on apartment buildings. Office REITs will be focused on the investments on office buildings. Healthcare REITs are mainly for real estate assets of hospitals, medical centers, nursing facilities, and retirement homes. The second category of REITs is mortgage REITs. Instead of investing in the real estate properties and collecting rent as the main income, mortgage REITs usually invest in property mortgages, mortgage-backed securities and related assets, and mortgage REITs normally earn income from the interest payments on their investments. The third REIT category is the hybrid category, which is a combination of the equity REITs and mortgage REITs. To qualify as a REIT, there are a bunch of requirements for the company. The requirements might be slightly different in different countries. In the United States, REITs must distribute at least 90% of their annual taxable income as the dividends to shareholders. Also, at least 75% of its assets must be invested on real estate, cash, or U.S. Treasuries, and at least 75% of its income should be coming from rents, interest payments from mortgages, or the sales of real estate properties. There are also some requirements for shareholders, such as a minimum number of 100 shareholders is required after 1 year, and the top 5 shareholders are not allowed to hold more than half of the shares of the REIT, etc. Thanks for watching. If you like the video, please hit the like button or subscribe button for more interesting topics.